Silver just smashed through $93. And what's driving it isn't just inflation or fear. There's a deeper chain reaction unfolding right now: industrial demand, policy uncertainty, and a market that may be overstretched. Subscribe to my channel and press the bell icon to get latest update about silver market. Hey everyone, John AG here. Today we're breaking down the viral headline shaking the metals world: silver surging past $93. That number isn't just a price, it's a psychological line that turns casual observers into stampeding crowds. Let's zoom out for a second. Silver didn't crawl to $93, it launched there. According to CNBC, spot silver climbed from around $30 an ounce to roughly $93 at its recent peak, a move of about 210% in roughly a year. That kind of run doesn't happen quietly. It changes behavior, it changes headlines, it changes the way the average investor thinks about safe assets. And here's the key: silver is not gold. Silver wears two hats. It's a precious metal and an industrial metal, and that dual identity is exactly why the move is so explosive. More than half of global silver demand is tied to manufacturing uses: electronics, solar panels, electrification, real-world consumption, not just investor emotion. So when silver breaks records, it's not only about people trying to hedge. It can be about companies needing supply, industries locking in inventory, and a supply chain under pressure. Now, if you're watching this and thinking, okay, John, but $93 isn't the top, right? I'm not here to call a top. I'm here to map the forces moving the market. Because right now, we're seeing three things collide. First, industrial demand that keeps rising. Second, investor demand driven by uncertainty around inflation, rates, and trade policy. Third, market structure and technical momentum that can turn a rally into a vertical spike. And the story gets more intense. After hitting near $94, we also saw signs of violent pullback behavior, prices dropping sharply as traders hit resistance zones and took profits. Source. So the real question isn't, did silver hit $93? The real question is, why did it get there so fast, and what comes next? Let's talk about the fuel behind this rally. Industrial demand, the part of silver's story most people underestimate. CNBC highlights a major reality. Unlike gold, silver is heavily tied to industry. More than half of demand comes from manufacturing, driven by uses like electronics, solar panels, and electrification. And here's what that means in plain language. Even if investors get nervous, factories don't stop needing silver overnight. Source. Silver is one of the best electrical conductors on Earth. That's not trivia. That's why it's hard to replace. In high-performance electronics, power systems, advanced manufacturing, and solar tech, substitution isn't simple. If a manufacturer needs that conductivity and reliability, they pay the price or they pause production. Neither option is small. And look at the global trend line. Electrification isn't slowing down. EV infrastructure, grid upgrades, renewable energy buildouts, these are multi-year projects. When capital floods into those sectors, silver demand doesn't just rise, it can compound. Now, let's connect this to what we're seeing in news flow. One report notes silver's momentum is being supported by tightening supply dynamics and strong demand from energy transition sectors, electronics, and electrification segments. That's basically the same demand engine CNBC referenced, just expressed as a market driver. So why does demand matter so much at this moment? Because when demand is steady or rising, prices become more sensitive to any disruption. Trade uncertainty, shipping bottlenecks, inventory hoarding, or even speculation that supply is tightening. In that environment, it doesn't take much to spark a scramble. This is why silver rallies can look irrational to the public, while still being rooted in very rational industrial math. If manufacturers believe next quarter's silver will be more expensive, they may buy earlier. If investors believe industrial buyers are locking supply, investors buy too. That feedback loop can push price higher than models expect. And here's where it gets viral. People see silver move like a tech stock. Headlines explode. Shorts go crazy. Everyone asks the same question. Is $100 next? But demand alone doesn't create a straight line upward. It creates pressure. And pressure plus macro triggers plus momentum traders equals what we just saw, $93. Now let's shift to the macro layer, the big money backdrop. Because silver doesn't just move on manufacturing, it moves on narratives, inflation, interest rates, dollar direction, and geopolitical risk. CNBC points out that this rally is happening alongside uncertainty around trade policy, inflation, and the interest rate outlook, and that environment tends to lift precious metals as investors search for protection. Here's the simple rule. When real yields fall, or investors expect them to fall, holding metals becomes more attractive. Metals don't pay interest, so when cash and bonds look less rewarding, the opportunity cost of holding silver goes down. And according to one market recap, macro factors remain supportive with expectations of lower real interest rates and a weaker US dollar, plus geopolitical tensions increasing safe haven appeal. That combination is basically jet fuel for metal sentiment. Now let's be real. Silver is volatile. So macro support doesn't mean up only. It means the market has a reason to keep buyers interested even after pullbacks. And that's why this move feels different to many investors. It isn't only a speculative pop. It's happening in a climate where people are actively questioning currency strength, inflation persistence, and where policy is headed next. Also, CNBC mentioned the role of investor access, especially through ETFs like iShares Silver Trust, SLV, which surged massively alongside spot price. That matters because ETF flows can become a demand channel of their own. When retail piles in, funds buy physical silver to back shares, increasing pressure on supply. So in a way, we have two demand streams. Industrial demand that needs silver to build the future. Investor demand that needs silver to hedge the present. When both rise together, price action can get extreme fast. But extremes have consequences, which takes us to the next section, the pullback risk, the resistance zones, and why $93 is not just a breakout level. It's also a battlefield. Let's talk technicals, because even fundamentals need a path to move through. And right now, the market is signaling something important. $92, $93 is a major decision zone. One report described silver nearly touching $94, then dropping more than 8% to around $86 in a sharp reversal, with analysts citing technical resistance at $93 and profit booking as key drivers. That is exactly how major breakout zones behave. They don't just break, they get tested, defended, and sometimes rejected before the next leg. And here's what's critical. The same coverage notes that a sustained breakout above $92 to $93 is an important step before markets can seriously talk about the $100 level. In other words, $100 isn't just a few dollars away. It requires confirmation and follow-through. Now, let me translate that into trader psychology. When a price hits a record level, three groups appear. Group 1, long-term holders who finally feel validated. Group 2, late buyers chasing the move because they can't stand missing out. Group 3, professionals who start taking profits into the excitement. The third group is why you see sudden drops. Not because the story died, because the market got crowded. Another angle comes from an investing.com analysis that describes silver's rally as a vertical moonshot and warns about overextended parabolic behavior. The article argues that such moves often end with sharp symmetrical declines, and it frames this rally as driven heavily by momentum and speculative FOMO. Whether you agree with the tone or not, it highlights a reality. When price rises too fast, the market becomes fragile. So what do we do with that? We stop thinking emotionally. We start thinking structurally. A market can be bullish long-term and still dangerous short-term. These are not contradictions. They are two time frames. This is why your plan matters more than your prediction. Because silver can swing violently up and down, especially around levels like $93 where the whole world is watching. All right, this is the core of the video. What's actually powering the move? I'm going to frame it as a three-force stack. When all three forces align, silver doesn't drift. It surges. Force number 1, industrial demand that won't wait. As CNBC explained, silver demand is heavily industrial. Electronics, solar, electrification. That means silver is tied to real production cycles, not just investor mood. Macro uncertainty plus safe haven rotation. Uncertainty around rates, inflation, and policy pushes capital into metals. And as another report notes, expectations of lower real interest rates and dollar softness can support precious metals because they reduce the opportunity cost of holding them. Add geopolitical tension, and you get a classic risk-off bid. Market structure and accessibility. This is the modern accelerant. ETFs and instant access. CNBC referenced iShares Silver Trust, SLV, as a key route investors use to gain exposure. When prices run, money can pile in quickly, faster than physical markets can adjust psychologically. Now, here's the viral twist. The stronger the move, the more attention it gets, and the more attention it gets, the more late liquidity arrives. People who weren't interested at $40, weren't interested at $60, but suddenly become convinced at 90 plus. That's why you see record highs and sudden drops in the same week. That's not random. That's a crowded trade, forming and unforming in real time. So yes, silver can be powered by real fundamentals, but the speed of the move is often powered by positioning, sentiment, and momentum flows. This is why in every silver mania, the big danger isn't being wrong long term. The big danger is getting forced into a bad decision short term because volatility shakes you out. Which leads us to the final section. What to watch next, what levels matter, and how to think like a risk manager instead of a headline chaser. So where do we go from here? First, let's respect the chart and the headlines, but not worship them. We've already seen how quickly silver can reverse. A push near $94 followed by a sharp drop, with $93 flagged as a key resistance level and profit-taking kicking in hard. That alone tells you one thing. Volatility is not a side effect. It's the main feature. Second, the market has basically drawn a map. If silver holds above the $92 or $93 zone consistently, it strengthens the argument that $100 becomes a realistic magnet. If silver fails there repeatedly, you can see continued shakeouts, fast drops that scare late buyers out of positions. Third, don't ignore the parabolic warning. The Investing.com analysis argues silver has moved into extreme territory and that parabolic surges historically don't end gently. Again, you don't have to accept every conclusion, but you should respect the principle. Fast markets punish sloppy planning. Now for viewers, what should you watch this week? Watch the macro headlines, rates, inflation expectations, dollar moves. CNBC tied the rally partly to uncertainty around those exact factors. If that uncertainty intensifies, metals can stay bid. If the narrative flips, silver can snap lower even with strong industrial demand. And finally, your strategy must match your time frame. If you're a long-term believer in silver's industrial role, you think in years. If you're trading the breakout, you think in levels and risk. Because the market doesn't care about your conviction. It only cares about liquidity and timing. I'm John A.G. If you want more updates like this, real drivers, real levels, no noise, subscribe and hit the bell so you don't miss the next silver market alert.